Debt Market Update, April 2021. April 2021 was an eventful month for Indian debt markets. The 10-year G-Sec yields ended the month approximately 14 basis points lower compared to last month end on back of dovish monetary policy and announcement of G-SAP 1.0 by RBI, with upfront commitment to purchase INR 1 trillion for Q1 FY22. Further, part cancellation of government borrowings in auction by RBI, news of strong fiscal revenue collections, and easing of US Treasury yields also had a moderating impact. However, the fall in yields was limited due to rise in inflation and oil prices, along with volatility in INR. The spread between 10-year AAA-rated corporate bond and 10-year G-Sec widened during the month. The average net interbank liquidity surplus grew in the last month, aided by OMO purchases by RBI and soft credit growth vis-a-vis deposit growth. However, this is likely to moderate slightly in May 2021 as CRR requirement increased from 3.5% currently to 4%. FPI flows in debt markets continued to remain weak and were only marginally positive in April 2021. On a cumulative basis, in 4M CY21, FPI's net flows into debt has been near zero compared to net outflows of $9.6 billion during the same period last year. Outlook. In its MPC meeting held in April 2021, RBI left the policy repo rates and accommodative stance unchanged. The minutes of MPC meeting released later during the month were largely in line with expectations, with many members highlighting the surge in COVID-19 cases as headwinds to growth normalization. Further, they highlighted need to nurture growth and need to support it despite CPI being at elevated level. While many raised concerns over elevated core CPI, they expect it to remain within the target range of 2% to 6%. The monetary policy was perceived dovish by market participants, especially given the announcement of G-SAP 1.0. Further, RBI governor emphasized that this is likely to be followed by similar programs during FY22. While in effect this is similar to OMO's purchases only, the upfront commitment gives a certainty to investors. It also conveys RBI's seriousness about seeing through the government market borrowing program with minimal disruption in yields. Recently announced proactive measures taken by RBI to support the vulnerable section and advance announcement of second tranche of G-Sec purchases under G-SAP reiterates its commitment. During its address, RBI governor also stated, "We are committed to go unconventional and devise new responses as and when the situation demands." Coming to yields, since the beginning of 2021, the macroeconomic environment has turned adverse towards yields. These include rise in international crude prices, increase in 10-year US Treasury yields, higher than anticipated fiscal deficit, resilient CPI and rising WPI, rally in global commodity prices, etc. In our view, these factors could continue to impact G-Sec yields adversely, at least in the near term. Further, high SLR holding of banks and signs of broad-based improvement in economic activity can also push yields higher. However, despite multiple negative factors at play, the 10-year yields have risen only by 17 basis points in 2021. The muted rise in yields is attributable to continued intervention by RBI through conventional and unconventional measures, including OMO purchases, TLTROs, G-SAP, continuous reassurance to market through explicit communication, etc. The past actions of RBI and recent comments by RBI governor suggest that it will continue to intervene going forward as well and is likely to limit any sharp increase in G-Sec yields. Further, possibility of lower inflation from Q3 FY22 onwards can also limit the upside in yields. Again, comfortable outlook on balance of payment, muted credit growth, low global rates, and ample liquidity also bode well for yields in India. The recent rise in COVID-19 cases pose a risk to growth and can put downward pressure on yields. While possibility of additional fiscal measures in light of recent rise in COVID-19 cases can widen fiscal deficit, but given the conservative revenue and expenditure assumption, it is unlikely to exceed budget estimates. In view of the above, we expect yields to trade with a slight upward bias, though the upside should be limited to a certain extent. However, use of longer tenure VRRR can result in yields at the shorter end of the curve rising and thus reducing the term premium. Considering the above, we continue to recommend investment in short to medium duration debt funds if needed in a staggered manner in line with individual risk appetite. While credit environment still warrants caution, measures by RBI have eased the spreads on AAA-rated bonds significantly. However, opportunities exist in select pockets of non-AAA-rated bonds as their spreads relative to AAA-rated bonds are still trading at attractive levels. Hence, allocation to credit-oriented schemes or funds with some non-AAA exposure can be maintained or increased in a phased manner in line with individual risk appetite. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.